If they wanted to teach you, they would, but they're furus and they don't know it, so I'll do it. Have you ever wondered why rate cuts are bearish for a currency, even though rate cuts are meant to stimulate an economy? Well, with investors and market participants, it all comes down to one simple thing, which is yield. And yield essentially just means the return that you get. So back in 2016, the US had an interest rate of 0.5. The Fed then hiked rates throughout that period into 2019 to 2.5. So if you're an investor and you look and say, oh, I'm only getting a 0.5% yield, but in the other currency I get 2.5 or 3 or 4, that currency is more attractive. But as soon as that Fed starts hiking rates to 2.5, that makes the US dollar more attractive. So we'll see capital inflows to people holding dollars because their yield is now higher. And vice versa, when we see these rates getting cut, that's not just the rates, that's also the yield getting cut. So from 2019 into 2020, we saw this rate cutting cycle making that currency less attractive. So during this period, it's not just rates getting cut, it's also capital outflow from that currency into higher yielding assets. And you can see here from 2021 all the way up into 2023, we had a massive rate hiking cycle because the dollar is now more valuable for investors to hold, leading to more capital inflows, leading to the dollar strengthening. Don't forget, the markets always front run rate decisions. So do not look at a meeting on a Friday and say, oh, the Fed's just cut rates, now the currency's going down. You're too late. The currency's already devalued from the speculation of that rate decision beforehand from previous guidance. Guys, make sure you're following me for real trading information, because these gurus are not telling you because they don't want to. It's because they purely don't understand how the financial markets work and how economies work.